It's getting harder to hide. Silver isn't trading at $78 because the world decided that's what an ounce of silver is worth. Silver isn't trading at $78 because mine supply suddenly expanded. Silver isn't trading at $78 because industrial demand quietly collapsed. And silver isn't trading at $78 because the ETF holders all woke up the same morning and decided to sell. Silver is trading at $78 in London, while physical silver is trading at $88 in Shanghai. Because two markets that used to be one market are no longer one market. The arbitrage that's supposed to close that gap has stopped working. The mechanism that's supposed to keep prices aligned across the world has broken. And every week the gap stays open. The explanation that's actually true gets harder for the financial press to ignore. Not a delay, not a temporary friction, not an exchange rate quirk, a structural separation. Welcome back to the Macro Mirror. In this breakdown, I'm going to walk you through exactly how big the gap between paper and physical silver has become with real numbers from real exchanges as of this week. I'm going to explain why China's January export restrictions changed the global silver market in ways the financial press still hasn't priced. I'm going to show you what the smart institutional money has been doing while retail watched the price chart. I'm going to give you the counter-arguments fairly, because they exist and they matter. And I'm going to give you the four signals that will tell you when the convergence between paper and physical has to happen. Quick favor before we go further, subscribe. If you want clean breakdowns of macro chaos when it actually matters, not hype, not cheerleading, just the mechanics, hit the bell. The convergence between paper and physical doesn't announce itself. It announces itself through the price you can't get at the dealer counter. Let's get into it. Let me start with the numbers, because every silver thesis that doesn't start with the actual data is just opinion in a louder voice. As of this week, the LBMA spot price for silver is approximately $78 per ounce. That's the benchmark Western price, the number you see on financial TV, the number quoted in newspapers, the number a New York hedge fund sees on its Bloomberg terminal. Now look at the same metal in a different market. Shanghai Gold Exchange physical silver is trading at a 12 to 13% premium over the LBMA spot price. That puts the Shanghai delivered price near $88 per ounce. And in late January of this year, when the new export restrictions kicked in, the Chinese reference quotation reached almost $17 above the London price. A roughly 17% premium that held for weeks before settling into the current 12-13% range. Let me make sure that lands. The same physical metal on the same day, with the same purity standard, costs $10 more per ounce in Shanghai than it does in London. There is no shipping cost, no tax difference, no exchange rate confusion that justifies a $10 gap. There is one explanation, and it's the explanation that makes the rest of this video make sense. The arbitrage that's supposed to close that gap by physically moving silver from the cheaper market to the more expensive market is no longer functioning. The premium isn't friction. The premium is the price discovery happening in the only market where it's still allowed to happen freely. Now, look at the volume. China imported approximately 790 tons of silver in just January and February of 2026, including 470 tons in February alone. That's the highest two-month import figure in 8 years. While the LBMA price has been correcting from its $121 January peak, Chinese physical demand has been accelerating. Two markets, one metal, opposite signals. When that happens, one of the prices is wrong. And the historical pattern is that the price quoted in the physical market, the market where actual metal changes, hands for actual production, tends to be the one that's right. And here's where the story moved from market dynamics into something genuinely different. On January 1st, 2026, the Chinese government implemented strategic silver export restrictions. Only 44 state-approved companies can now export silver, and only with special government licenses. Goldman Sachs, in a research note that didn't get nearly enough attention, warned that this licensing system could transform the global silver market from an integrated system into isolated regional inventories that don't respond to each other. Read that carefully. Goldman Sachs, not a doom niche YouTube channel, not a precious metals newsletter, is openly describing the silver market as potentially fragmenting into isolated regional pools. When that happens, the concept of the silver price stops being meaningful. There's a Shanghai price, there's a London price, there's a New York futures price, there might be a Dubai delivered price and a Mumbai jewelry grade price. Each one starts to reflect local supply and demand. And the global benchmark, the one most retail investors look at, becomes increasingly disconnected from the price anyone actually pays for metal they can hold. So here's the first lesson. In a fragmenting silver market, the LBMA spot price isn't lying. It just isn't telling the whole truth anymore. It's the price of a financial instrument that says it represents physical silver. The price of physical silver itself is something different, and the gap between them is the most important number in the silver market right now. Let me get more concrete about how the arbitrage actually breaks. Because the system isn't working sounds abstract until you understand the human chain that connects these markets. Picture a bullion desk in Zurich. Tuesday morning, 7:14 a.m. local time. The senior trader pulls up his terminal and sees Shanghai silver pricing at $88, LBMA spot at $78, $10 per ounce. On a million-ounce trade, that's a $10 million arbitrage opportunity. His instinct, trained over 15 years, is to short LBMA, buy Shanghai delivery, ship the metal, and pocket the spread. He's done this trade 100 times before. It's the most basic operation in commodities. Buy cheap, sell dear, transport the difference, capture the gap. But this morning, when he calls his Shanghai counterparty to arrange the physical leg, the conversation goes differently than it has for 15 years. The counterparty explains, politely, that the export license required to ship the metal out of China would take 6 to 8 weeks to process. And even then, the volume he'd be permitted to ship might be a fraction of what he wants to move. The counterparty suggests he could buy domestic Chinese inventory at the Shanghai price, but he can't take it out of the country. The arbitrage trade, the one that's supposed to close the gap automatically, has just been disabled. Not by a market force, by a policy decision made in Beijing on January 1st. He hangs up. He runs the same call to 2 more counterparties. Same answer. He files an internal memo to his risk committee explaining why a $10 spread that would have been arbitraged within hours in 2024 is now sitting open and growing. By the time he leaves the office Tuesday evening, the spread is $11. By Friday, the bullion desks across Europe have all run the same playbook and gotten the same answer. The arbitrage is dead. The price gap will stay open until either Chinese policy changes or Western prices rise to meet Asian prices. That's the mechanical reality underneath the abstract concept of fragmenting markets. It's a phone call that used to result in a trade and now results in a memo, multiplied across every bullion desk in every Western financial center, every day, for the last 4 months. So here's the second lesson. When the global arbitrage mechanism breaks, the Western price stops representing the price of silver. It starts representing the price of silver-flavored financial instruments that no longer have the ability to convert into physical metal under normal market conditions. 2 different things, sharing one ticker symbol, drifting further apart with every passing week. Now watch what the smart money has been doing while retail watched the chart. Because this is where the disconnect between the surface narrative and the structural reality gets most clear. Through the entire correction from $121 in January to $78 today, the smart money signals have all moved in the opposite direction from the price. China's silver imports hit 8-year highs during the correction. COMEX registered inventory continued to drain through the drawdown. Lease rates, the cost institutions pay to borrow physical silver, have repeatedly spiked to extreme levels well above 8% during stress periods, when the historical normal is closer to 0.5%. The Shanghai premium has stayed elevated rather than collapsing toward parity. Sovereign and emerging market central banks have continued to allocate gold reserves at multi-decade highs, and gold's strength is part of the same monetary thesis that makes silver structurally bid. And here's the part that should make you reread it. The retail narrative during the correction was the silver bubble popped, but the institutional signals show the opposite. Falling inventory while prices fall means buyers are accumulating into weakness. Rising lease rates mean institutions cannot find physical metal to borrow. Persistent regional premiums mean the arbitrage system is still broken, which means the underlying tightness hasn't resolved. Let me put the historical pattern under a microscope. Because silver has done this before, twice in living memory, and the pattern is specific. In 1979 and 1980, the silver market faced a different version of the same situation. The Hunt brothers had been taking physical delivery month after month, and registered inventory had been draining from COMEX vaults. Silver ran from $6 to $50 in roughly 12 months. The financial press explained the move as a corner. The mechanical reality was that the physical market had been quietly tightening for 2 years before the price moved. By the time the move was visible to retail, the easy gains were already gone. The exchange ultimately broke the rally by raising margins repeatedly and implementing Silver Rule 7. But the supply situation that drove the squeeze had been visible to anyone watching warehouse data for years. In 2010 and 2011, the same setup. Silver ran from the mid-teens to nearly $50 inside of a year. Lease rates spiked. Physical premiums expanded. Mints across the world reported supply constraints. The financial press explained the move as speculation by retail investors after the financial crisis. The mechanical reality was that industrial demand from electronics, solar, and emerging market jewelry had outrun mine supply for several consecutive years. The buffer had been drawn down. Sound familiar? When the move ended, it ended on a series of margin hikes. 5 raises in 9 days, not on a change in fundamentals. Demand didn't disappear. Leverage was forcibly removed. And now, late 2025 into 2026, silver is doing it again. The cumulative deficit since 2021 is approximately 762 million ounces, roughly 3/4 of a full year of global mine supply, drawn from above ground stocks. The 2026 deficit is projected at 46 million ounces, marking the 6th consecutive annual shortfall. China has now added an export license layer that prevents the global arbitrage from closing the regional price gap. Industrial demand is accelerating across solar, EVs, AI infrastructure, and grid modernization. Every structural factor that drove the 1980 and 2011 squeezes is present today, with one factor, the Chinese export licensing, that didn't exist in either prior episode. Is that proof the convergence happens via Western prices rising rather than Eastern prices falling? No, I'm not making that promise. I'm explaining incentives and mechanics. Because incentives matter. Let me get the second mechanism right too. Because there's a real argument on the other side of this thesis, and your channel doesn't get to dismiss it. The bear case on silver isn't crazy, and it isn't dishonest. LONGi Green Energy, one of the world's largest solar panel manufacturers, has announced mass production of copper-based solar cells starting in the second quarter of 2026. If other manufacturers follow, the silver intensity of solar manufacturing could decline meaningfully. The joint venture between Stellantis and Factorial has validated a semi-solid battery cell that doesn't require silver. Bloomberg intelligence analysts have publicly stated that the supply deficit alone is not enough to push silver back to the January highs. These are real, named, sourced counterarguments from credible institutions. If you ignore those arguments, you're a doom channel. If you address them honestly, you're an analytical channel. So let me address them honestly. The substitution risk is real but slow. Solar manufacturing capacity decisions are made on 5 to 7 year capital cycles. Even if LONGi's copper-based cells succeed commercially, the existing installed capacity for silver-based cells doesn't get retrofitted. It gets replaced over decades. The substitution affects new capacity, not installed capacity. And the absolute level of new solar deployment is growing fast enough that even at lower silver intensity per panel, total silver consumption from solar is projected to keep rising for the next several years before flattening. Bloomberg Intelligence's caution on a return to $121 is also fair. The path from $78 back to $121 is not automatic, and a price target above the previous high requires either a clear catalyst or a sustained reacceleration of the deficit. Neither is guaranteed. So here's the honest framing. The silver bull thesis is not silver goes to the moon next month. The silver bull thesis is the structural deficit and the broken arbitrage create a price gap that has to converge over a multi-year window. And the convergence is more likely to happen via Western prices rising than via Eastern demand collapsing. That's a different statement. It survives substitution risk, it survives short-term volatility, and it survives the fair counter-arguments from Bloomberg and Goldman. When the global arbitrage is broken, when the deficit is in its 6th consecutive year, when the largest physical consumer is running an explicit accumulation policy, when industrial demand is structural rather than speculative, and when the Western price is set by leveraged paper claims that exceed registered physical metal by an order of magnitude, the convergence isn't a question of if, it's a question of when and via which side of the gap. So ask yourself, when the Shanghai price has been 12 to 13% above LBMA for months, when imports are running at 8-year highs, when the arbitrage that should close the gap has been administratively disabled, and when every prior silver squeeze in modern history has resolved through Western price rises rather than Eastern demand reductions. What does a 35% correction in the LBMA paper price actually represent? An accumulation window before the convergence, or a permanent revision lower in fair value? Now let's read the current action like a forensic report. The forensic case for accumulation rather than top is built on signals that didn't behave the way they would behave if this were a real top. In a genuine top, you would expect the Shanghai premium to collapse as physical demand exhausts. It hasn't. It's held in the 12-13% range with periodic spikes back toward 17%. You would expect Chinese imports to slow. They've accelerated. You would expect lease rates to normalize. They've stayed elevated and spiked above 8% during stress periods. You would expect COMEX registered inventory to refill as forward demand reduces. It's continued to drain. You would also expect the institutional research desks to revise targets downward. They haven't. JP Morgan's gold target of $6,300 by year end is the institutional anchor for the entire monetary thesis that includes silver. Bank of America, Citigroup, and several macro strategy desks have constructive views on the metal complex through 2026. Even traditionally cautious institutions have adjusted forecasts upward, not downward, during the correction. That's not the institutional behavior pattern that accompanies a genuine top. Every structural and institutional signal points the opposite direction from the surface paper price. That divergence is the signature of a market in pause, not a market in reversal. So here's the cliffhanger. The LBMA paper price has corrected 35%. The Shanghai physical price has held within 12 and 13% of its peak. Chinese imports are at 8-year highs. The deficit is in its 6th year. The arbitrage is administratively broken, and the institutional consensus has not turned. This is not the configuration of a market that has settled into a new lower equilibrium. This is the configuration of a market where one side of the price has dropped while every structural indicator has refused to follow. When that configuration resolves, it resolves through one of two paths. Either the eastern price falls toward the western price, which would require a reversal in Chinese demand, an end to the export restrictions, and a refilling of western vaults, none of which is happening. Or the western price rises toward the eastern price, which is the path every prior silver squeeze in modern history has taken. Let me put the macro context around it. Because silver doesn't trade in isolation, gold is trading near $4,138, down roughly 10% from its $5,119 January all-time high. The gold-silver ratio has compressed dramatically over the last 18 months and continues to favor silver leadership in a precious metals rally. The Federal Reserve is in transition. Powell's term ends May 15th. Kevin Warsh's confirmation path opened on April 24th when the DOJ ended its investigation of Powell. The April 30th FOMC meeting is days away. The Iran ceasefire is fragile. Section 122 tariffs expire July 24th. The U.S. fiscal deficit for 2026 is projected at $1.9 trillion. National debt has crossed $39 trillion. Net interest payments exceed $1 trillion annually for the first time in American history. Every one of these factors is a tailwind for the precious metals complex. Silver, as the higher beta member of that complex with an additional industrial demand driver, has historically outperformed gold during sustained monetary regime shifts. The setup is rare. The convergence between paper and physical doesn't need to happen because of a single catalyst. It can happen because the broader macro regime forces a repricing of all monetary assets, and silver is the most leveraged play within that repricing. Here are the 4 signals that matter more than any headline you'll read this week. 1. The Shanghai premium over LBMA spot, currently 12 to 13%. Watch for a widening above 15% as a confirmation of accelerating physical tightness. Watch for a sustained narrowing below 8% as a sign that the regional fragmentation is healing. The premium is the single most important silver number in the world right now. 2. Chinese silver import volumes. The January-February 2026 figure of 790 tons is at an 8-year high. Watch the next monthly data release. If imports continue at that pace through Q2, the cumulative draw on global silver inventories accelerates. If imports slow meaningfully, a part of the structural thesis weakens. Watch the actual numbers, not the commentary. 3. COMEX registered inventory and lease rates together. Currently registered silver is at approximately 98 million ounces, down from 346 million in 2020. Lease rates have spiked above 8% during stress periods. If both deteriorate together, inventory falling while lease rates rise, the system is approaching a binding constraint. If lease rates normalize toward 1% while inventory stabilizes, the immediate squeeze pressure has eased. 4. Local dealer premiums in your own market. This is the signal you can verify yourself this week without a Bloomberg terminal. Walk into a bullion dealer or check 3 online retailers. If retail premiums on American Silver Eagles or generic silver bullion stay elevated or expand while the LBMA spot price is flat or falling, the physical paper divergence is reaching the retail level. If premiums collapse, the paper price is winning the convergence battle. The dealer counter is where this thesis is most directly testable for retail investors. Now I'm going to ask you 2 questions, and I want your honest answer in the comments. First, pick a price. Where does silver trade by December 31st, 2026? And commit to a specific number. $90, $102, $130, $175? Or do you think the bear case wins and silver retraces to $54 or below? Drop your number. Drop the catalyst you think drives it. Don't hedge. The audience that commits to numbers is the audience worth talking to. Second, of the 4 signals, Shanghai premium, Chinese imports, COMEX inventory and lease rates, or local dealer premiums, which one is the most reliable leading indicator of the convergence? This is the question that will produce the most intelligent comment thread because the answer requires real thought. If you've been in this market longer than 5 years, you have an opinion. I want to hear it. Now, what should you expect next? Expect volatility. The structural thesis is not a daily chart thesis. The convergence between paper and physical happens over quarters, not minutes. Daily price action will shake out anyone who doesn't understand the structural setup. Don't confuse choppy retracements with thesis failure. Expect narrative attempts to shake confidence. You'll see them this week and next. You'll see articles arguing that the Longai copper cell announcement is the death of the silver thesis. You'll see commentary from analysts who didn't understand the deficit story explaining why the deficit doesn't matter. You'll see silver bubble popped pieces in mainstream financial media. Some of these arguments are honest and worth considering. Most are reactive narrative that needs to be discounted. And expect opportunity to appear exactly where fear is concentrated. The current $78 LBMA price represents a 35% discount to the January peak. The Shanghai Premium represents a roughly 12% additional gap to the global physical price. The total convergence target, paper LBMA price meeting Shanghai physical price, is currently around $88. That's a 13% move from current LBMA spot. And that's just the convergence to current physical reality. Any further acceleration of the deficit, any further Chinese accumulation, any further deterioration in the COMEX coverage ratio expands the convergence target beyond $88. I'm not telling you what to buy. This is education, not personal financial advice. Your situation is your situation. But I'm telling you what's happening right now with real numbers from this week. Silver LBMA spot is at $78. Shanghai physical is around $88. Chinese imports are at 8-year highs. The export restrictions are in place. The arbitrage is broken. The deficit is in its 6th year. JP Morgan, Bank of America, and Citi all have constructive views on the metal complex. Goldman Sachs is openly warning about market fragmentation. And the financial press is still describing this as a routine correction. Amateurs watch one price. Pros watch the gap between two prices. The amateur tape says silver is in a downtrend. The professional tape says the global silver market has fragmented into regional pools, and the convergence is mathematically required. Silver has been monetary metal for 5,000 years and an industrial metal for 100. It has priced every major divergence between official prices and physical reality in modern monetary history. It is now pricing one again, and the convergence, when it comes, will not be subtle because the gap that currently exists is not subtle. So here's the clean summary. LBMA silver is at $78. Shanghai silver is at $88. Chinese imports are at 8-year highs. The export licensing system that took effect January 1st has administratively broken the global arbitrage. COMEX registered inventory is at 98 million ounces, down 70% from 2020. Lease rates have repeatedly spiked above historical norms. The deficit is in its 6th consecutive year. Goldman Sachs is publicly warning about regional market isolation. JP Morgan is constructive on gold at $6,300. The institutional consensus has not turned bearish during the correction. And the financial press is calling it a routine pause in a rally that they themselves never explained correctly on the way up. This is where the serious holders of monetary assets separate from the tourists. The tourists watch the LBMA quote on financial TV. The serious holders watch the Shanghai Premium, the import data, the lease rates, and the dealer counter. If you want the next breakdown, the moment the next premium spike happens, the moment the next inventory threshold breaks, the moment the next major institution publicly acknowledges the fragmentation, subscribe. These events don't announce themselves on the channels that are paid to keep you looking the other way. Hit the bell so you catch the next move before the headlines do. Drop your December 31st price target in the comments. Tell me which of the 4 signals you trust most, and I'll see you in the next one.